Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, forget about inflation fears. Now stagflation is rearing its head, and some of the work being done to get Canadian businesses prepared for a trade war. Plus, there are still too few women and girls pursuing the sciences. So what needs to change? That's all ahead. First, for the week that was in business, it's time for the briefs. Inflation in Canada rose in February. The 2.6% increase was more than most economists expected. The end of the GST holiday played a role in prices rising in the second half of the month. The increase comes as the central bank in Canada is already watching for inflationary impacts from tariffs in the weeks ahead. The bank lowered interest rates last week, but some economists now think it will pause there to assess the damage. The U.S. central bank held rates steady this week as expected, but there was more focus on concerns about stagflation, the worst-case scenario of rising prices but a shrinking economy. The Fed noted that risk in its report. Hudson's Bay plans to close stores in Canada and liquidate inventory in an effort to avoid bankruptcy. That includes $415 million of inventory still in stores. The oldest company in the country employs 9,000 people, now facing layoffs as it struggles to meet its debt obligations. HBC's 96 stores are a significant tenant to malls across the country, putting pressure on some large real estate companies. U.S. clothing retailer Forever 21 will shutter its 500 stores in that country, its second bankruptcy proceeding in 6 years. The retailer joins a list of other similar fast fashion brick-and-mortar players unable to compete with online rivals. The company operates about 300 stores outside of the U.S., which will be unaffected for now. The federal government will review its plan to purchase F-35 fighter jets from Lockheed Martin again. The jets have been in the works since 2010, but successive governments have scrapped and then renewed the plans. The agreement for 88 planes at $85 million U.S. each has been controversial in the past. Now it's being viewed through a whole new lens, one in which partnering with the U.S. on fighter jet technology might be less beneficial. The federal government will partner with Australia on a $6 billion Arctic radar system aimed at shoring up our northern defense. The new network replaces a Cold War-era system and aims to bolster Canadian sovereignty in the north. And those are your business briefs. With inflation rising in Canada and growth expectations falling, is it time to start worrying about stagflation? Aled Ab Iowerth is Deputy Chief Economist at CMHC. Aled, thanks for being with us.
Good to be with you.
It's a terrible situation when we see rising prices and tepid growth or no growth. Are we worried about that now?
Yes, we are. And particularly from the housing perspective, what we're concerned about is that there will be a lot of delays in decision making. Homeowners may delay purchasing a home, but perhaps more importantly, from the long-term perspective, is that developers, builders will delay building more housing. This is probably a wider issue in the economy because of this uncertainty. A lot of people will be delaying making decisions, and that leads to further challenges for the economy.
I mean, it comes, Aled, just as we were getting rate relief, and that, of course, might have begun, although it didn't seem to yet change the story for some developers. The financing was still not where they needed it to be. How bad is it when it starts to go the other way?
Very bad. We'd already seen a lot of uncertainty. We did not see a lot of construction taking place, particularly in Toronto and Vancouver, and this is going to exacerbate the situation. There are very few shovels going into the ground, particularly in the condo sector in Toronto at the moment. There is, fortunately, some rental construction going on, but there's a lot of delays and a lot of people taking a wait-and-see attitude. So, on the bright side, it will be a little bit easier to renew mortgages that were taken out a few years ago. Interest rates are a little bit lower than we had anticipated, and so we're not going to have that economic drag from people having to renew mortgages at high rates. But still, from a longer-term perspective, the uncertainty, the doubt, it's going to lead to a lot of delays in the housing system.
I don't want to fearmonger, but if we do see real stagflation, so inflation rising in a weak economy, might not our central bank have to raise rates in order to combat that inflation?
Well, that's a point for debate. I have to admit that my instinct is to worry a little bit more about the stagnation part of the stagflation, and so worry a little bit more about continuing economic growth. So That would be my primary concern. There is an argument for looking through any international uncertainty and just keeping an eye out on the long term. Hopefully, well, the bank, I mean, monetary policy moves very slowly. They probably have to keep an eye out on what's going to happen a few years hence. And so, given that scenario, given that timeline, looking past the current uncertainty and maintaining a perspective on long-term growth may be a better strategy.
We don't have a ton of time. We have not seen building keeping pace with the forecast you have made that we need to hit, the number of houses that we need just to stay level. Are you optimistic that's going to change?
Not in the short term, no, particularly in Toronto and Vancouver, but we're also increasingly concerned about prices going up and have gone up since the pandemic in places like Montreal and Halifax. We need a housing supply across the board, and the current uncertainty is not helping in that regard. Is
there something else that could be done to change it other than the macroeconomics?
I think we need broad-based effort across all of government, all of the industry. We need to improve productivity in the industry. As we do productivity across the economy, we need to get our regulatory system in check. We need to accelerate processes and just move to build more housing. So good to have you for this. Appreciate it, Aled. Thank you. Aled Ab Iowerth is Deputy Chief Economist at CMHC. Coming up, how businesses are taking action ahead of tariffs and the opportunities that presents. Stay with us. Welcome back. Keeping track of where tariffs stand has been a full-time job for business leaders. Here's a look by the numbers. As of this week, Canada has 25% tariffs on $30 billion of U.S. goods and is on standby for additional tariffs. The U.S. has 25% tariffs on all Canadian goods that they deem non-compliant with our free trade deal, and 10% tariffs on energy and potash products also deemed non-compliant. It's not entirely clear what that means. April 2nd is the deadline for the White House review of the trade situation. That could include reciprocal tariffs for Canadian tariffs, taxes like the HST, and any non-tariff barriers. Canada has another $95 billion of U.S. trade goods earmarked for new tariffs on April 2nd, depending on what happens. But China has also slapped tariffs on us, 100% on canola oil, meal, and on pea products, set to take effect this week, plus 25% tariffs on seafood and pork. The impact on growth is real. This week, the OECD lowered forecasts for Canada, now seen growing at 0.7% this year and next, down from the previous 2% growth rate. And it lowered growth expectations for the U.S., now 2.2% this year and 1.6% next, down from 2.4% and 2.1%, respectively. Businesses in Canada have been taking action ahead of those potential tariffs, including shipping products south of the border. But there is still a lot of a potential reckoning ahead for many, and many businesses that's on top of debt they're already struggling with. Jeff Brown is head of commercial solutions at Equifax Canada. Jeff, thanks for being with us.
Thanks for having me.
So we have seen this flurry of activity. Our businesses, let's start with finding it hard to finance the shipping of extra product, of extra activity ahead of what may or may not come.
Yeah, absolutely. As soon as the word tariff kind of crept into everybody's vocabulary here lately, credit managers have been really recommending sending as much product across the U.S. border as possible. And this is just to preempt the purchasing of goods moving forward. So as they go through and they ship this product across, it's being sitting in holding yards. We're seeing this in the steel and aluminum industry. And really, it's going to help insulate our industry a little bit here for a couple of months so that the importers are paying those fees on those products. So as they wait to see what other tariffs or other impacts could happen, at least they're protecting themselves in that particular industry.
So a little bit of insurance, that comes at a cost. Equifax's data from the end of last year shows that Canadian businesses do have a lot of debt already. Is it a concern for many, and does it put some in a more precarious position that they have new costs, they need to find new financing for activity that isn't necessarily value add?
Absolutely. I mean, there's a lot of fear and frustration in the market right now, and really a lot of businesses are using this as a trigger event. So not just something that we have to react to now, it's really going to dictate how they operate for the rest of the year. So while a lot of businesses were sitting and maybe planning what their 2025 was going to look like, what they're now doing is focusing on what their supply chain looks like. For individual businesses as well, yes, there was a lot of pandemic debt that they were still sitting on. The one silver lining to this is the Bank of Canada recently reducing that rate by 0.25%. And really that's going to help with the cost of borrowing here as a lot of businesses look to pivot and change how they operate here in the short term.
Yeah, that rate relief was coming just in time for a lot of people. That's true of consumers as well, households. But is it now going to be met with this kind of corresponding wave of, drop in sales because of tariffs, higher costs because of tariffs? Or are we going to see an increase in insolvencies even beyond what we've already seen? Is there too much stress out there, in other words?
There's a lot of stress, a lot of debt. I mean, if these tariffs, especially the reciprocal tariffs that we put in place, it's going to be more expensive for businesses to operate. A lot of businesses across Canada, across a number of industries, we're already operating on razor thin margins. So we saw double-digit increases on insolvencies, on collections all across 2024. So the timing comes at a very precarious time for a lot of businesses here in Canada. What we're really watching out for is how they respond. We're seeing changes in buying behavior by Canadians, but we're also seeing the U.S. market really go under here more recently. And it's an economy so big, it is really going to kind of pull us down with it. So we can react, we can pivot, and we can try what we can to at least protect ourselves here for the next few months. But if the U.S. economy really goes downhill, which it's essentially doing right now, it's going to pull us down with it as well.
We're going to leave it there. Jeff, great to have you with us for this. Appreciate your time.
Thanks again for having me.
Jeff Brown is head of commercial solutions at Equifax Canada. Diversifying our trade away from the U.S. has been a goal in Canada for decades without a whole lot of action. So is it different this time? Todd Winterholt is Senior VP International Markets for Export Development Canada. Todd, thanks for being with us.
Pleasure to see you again, Amanda.
And I guess this is where the question is, does this moment of crisis become an opportunity? What's your sense of how much we can move the dial on something we haven't had huge success on really for generations?
Yeah, I really do believe this is the moment that we see that change from theory and take shape now into reality. And at EDC, we're seeing a significant spike, not only in interest in terms of the number of exporters now really investigating secondary or tertiary markets, but also really trying to figure out how best to do that and the financial, the human, and information resources they need available to be successful.
When we talk to people about, why we go to the States, it's because, of course, the rule of law is clear there, ease of business, people pay on time, they pay quickly, they make decisions fast, all things that don't necessarily happen in some less fully developed markets. There's great opportunity in the world in less fully developed markets. What's the trade-off in terms of kind of the ease of doing business when we look to the South, where it might get more expensive but still be easier?
Yeah, I think it's a stepwise approach that makes sense here. So not every market is the right market for every exporter, every Canadian company. But Canada's in a really fortunate position, with over 15 free trade agreements, more than 51 countries covered by those agreements, including every G7 nation. There are a lot of markets that do have very similar rule of law, culture, experiences, customs, and taxation regulations that are reinforced by a trade agreement that make a lot of sense for Canadian companies. So I think it's about 2/3 of the consumer population of the world is covered by a free trade agreement. So it doesn't necessarily have to be the most far-flung new market for a Canadian company. It could be a destination in Europe or in the Indo-Pacific with whom Canada already has a trade agreement in place.
And in terms of the work, this is work that EDC is right in the middle of. Do you find that once you've opened doors for one company in a sector that others follow? In other words, that there's a real kind of externalities approach here where we get there and then it grows?
Yeah, very much, Amanda. I think there's kind of a partnership mentality that really works here. And so if I use the Indo-Pacific as an example, it's not really known, but there's almost 3,000 Canadian medium segment companies already exporting or even invested in the Indo-Pacific. And so those relationships that are in place, and then how you can leverage chambers of commerce, industry associations, even kind of competitors in your space, there's a lot you can learn from their success in some of these secondary markets. And so that seems like to be a real game changer. And when you layer that on then with some of the supports that are now available, including through EDC and our trade impact program as an example, we can mitigate some of those risks even further.
What do you think the government could do to help the most in this situation?
You know, it's interesting. We've heard a lot of feedback over the last month or so in terms of what are the true needs for Canadian companies to really start to think a little bit more broadly than their traditional trading relationships. And a lot of it is really knowledge. It really is about information. It's about market intel, understanding the regulatory environment of a new market, and maybe most importantly, business connections. So being able to find those new buyers, those partners that can really help you be successful in market.
Todd, so good to have you for this. Appreciate your time.
Thank you. Anytime.
Todd Winterholt is Senior VP International Markets for Export Development Canada. Coming up, how to break the barriers for women in male-dominated fields like science and tech. That's still ahead. But first, a delivery driver in California won a $50 million lawsuit against Starbucks after scalding hot tea spilled on his lap at a drive-thru in 2020. The jury verdict found the driver has suffered years of disfigurement, pain, dysfunction, and psychological harm from the accident. Starbucks reportedly offered to settle at $30 million in exchange for privacy. The driver opted to take the story of his privates very public and won the day. We're back after this. Welcome back. Despite some improvement over time in the number of women pursuing careers in the sciences, the numbers are still bad. They make up fewer than a quarter of those working in so-called STEM or science, tech, engineering, or math jobs. So how can we do better at moving the dial? Jennifer Flanagan is CEO of Actua. Thanks for being with us, Jennifer.
My pleasure.
Now, you've been looking at this about as long as anyone and doing really good work, especially across the whole age spectrum. So I want to start big picture with how you feel about where things stand, where the data stand now.
Well, there's certainly a lot of progress that has been made. So it's important to keep that in mind when we discuss the numbers like less than 25% of these jobs in STEM fields are held by women. That is true, and that is concerning. However, we have seen over the past couple of decades advances being made in specific areas of science. So we know there are more female doctors. We know that in areas of like biology and chemistry and other life sciences that women often surpass men in those fields. So we've made progress, but that's not to say that we should stop pushing forward, because we're still not seeing women in some of the more technology-based fields and also in leadership positions writ large.
And what do you think is, when we look at the areas where there's been success, can we learn from those for the others? In other words, what is working and how do we spread it around more broadly?
So I think what we know is that there are barriers that continue to exist for girls and women to pursue study in these areas, and then of course careers. So we have at Actua been really diligent about identifying what those barriers are. So we know that girls often they always enjoy science and technology. They're curious, they're creative, but they don't see themselves in those fields. So that's the biggest barrier, and they don't see themselves there because they don't have role models, because there isn't a lot of visibility for women in science. Sometimes it's very subtle messaging that they're receiving about who is in science and that isn't women. And sometimes it's very overt. They're told by teachers or by parents who don't have bad intentions, but they are telling them that, maybe there's other fields that they would be better suited for.
And of course, starting young is one of the best ways to change the pipeline into these fields. Is there also work to be done at the other end so that women that are in the field stay in them and don't move out of them, which we see a lot of that, where great work is done getting people to study these things, but then they don't actually end up in the professions or advancing in those professions?
Exactly. So, Actua focuses on youth right up into the, mid-20 area when they're in university. However, we know that women are still leaving the workforce in much higher numbers than men. And there's all kinds of reasons for that. There's workplace cultures that are still not welcoming to women. There are, childcare issues and a lack of balance in, the work being done at home and who does that work. And that affects the work that Actua does, because with women leaving, then we don't have as many role models. So it's really important that we all recognize that everyone has a role to play, from corporations and people who are hiring women, to schools, and then at home, to parents who really need to understand what's happening with their kids and how early girls are making decisions that close doors to science, which is in grade 9 and grade 10.
Obviously, there's a lot of personal choice about this. Women and girls will make decisions for themselves. Why is it important? What's the case you would make why it matters to the rest of us that genders are properly represented in the sciences?
So it matters, I say, at a very high level, it really matters to science. So we all want really good science outcomes. It affects healthcare, it affects climate, it affects our quality of life. And if we are only having half the population represented in that creative innovation sort of whole ecosystem, then we are missing a lot of talent. We're missing a lot of ideas. The science just is not as good. And we know that from a lot of science that was done, based on male patients, for example, in the healthcare industry. So that matters. It matters that we have major workforce gaps that we are facing down in areas of really big importance to this country, like artificial intelligence and advanced manufacturing.
Right.
And it just doesn't make any sense not to tap into half of our population.
Jennifer, so good to have you. Appreciate your time today.
My pleasure.
Jennifer Flanagan is CEO of Actua. Time for the takeaway and stuck between a tax and a hard place. With the consumer carbon tax officially on the chopping block, it seems inevitable that attention would turn to the industrial carbon plan. So far, the plan for big emitters has been under the radar as the more visible and easy to hate consumer price on carbon became a political football. It seemed as though even those making hay out of the consumer price might leave the industrial price alone. But alas, politics has entered the chat. Conservative leader Pierre Poilievre has officially said he would do away with the carbon pricing for big industry. Now it remains to be seen whether Liberal leader Mark Carney will follow suit. But it's worth taking a step back and reviewing what Canada's industrial carbon plan does. It is not a tax per se, though political spin doctors will call it that if they want it to be less popular. The plan is an emissions limit that allows the largest companies, those that export a lot of product, to earn credits for any reduction in their carbon footprint, rewarding them, in other words, for reducing pollution. But more important, it allows their global customers to give them credit too. Canada's biggest trading partners are implementing new carbon tariffs, and once they're in place, businesses that export but don't meet global emissions standards will find they're slapped with these border taxes. The EU's will be in place by next year. The US has a version of that plan as well, as does the UK. Since emissions and the harm they do is a global problem, it only makes sense that there be some global solutions. And countries that work hard at getting their own industry to reduce are within their rights to make sure that doesn't create a competitive disadvantage. But once those systems are in place, the disadvantage will be with any business that doesn't play by those rules. They risk losing customers and market share once their product is hit with an emissions-related tariff. In other words, Canada's industrial carbon plan isn't just good for the environment, it's good for business. My takeaway? Good politics can often make for bad policy. Here's hoping that when it comes to industrial carbon, we keep our eye on the price and the prize. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.